Today, we're taking a look at the struggle to hire and retain U.S. bank examiners. Super important after what happened with, say, First Republic and SVB. Joining us now, Bloomberg's Sally Bakewell. Sally, why? Why is it hard?
It seems pretty simple, doesn't it? And the FDIC, which is one of the top U.S. banking regulators, it has been very explicit about the fact that it had resource challenges, which contributed to this sort of lackluster supervision, which occurred back in March. And, as we know, very dramatically, we saw the failures of a number of banks, including Silicon Valley Bank and Signature Bank. And the FDIC even said that it was resource challenges, particularly in regional-based resource challenges in New York, that contributed to the timeliness and quality, in its words, of its supervision and examinations of the bank. So we have sort of regulators fearing that they will miss or they will fail to react to in a timely fashion the alarms that are sounded, or because Bloomberg also reported that the alarms were sounded at banks like Silicon Valley Bank, but unfortunately they went nowhere. And so regulators, their whole job is to not miss potential future crises, and they want to be very careful not to do that again, and especially since they have flagged already resources challenges.
Sally, how understaffed are they, and what's the wage gap between working for a regulator and working for Wall Street?
So federal supervision staff shrank by about 3% since 2016. Now, reasons for that. These are environments that they have to keep up with a lot of different challenges, such as crypto and then the tech sector. Now, also, there is an issue with pay. It can lag, public sector pay can lag the private sector, and potentially an entry-level government examiner may be paid less than $100,000. So that isn't necessarily the biggest attraction to sort of the best and brightest talent. It is also expensive to train up banking examiners. It could cost anywhere between sort of around $400,000 to train sort of the top-level examiners. So it is a challenging environment to retain and hire staff, and we see that the FDIC and the Fed are struggling.
Also, I mean, if you read the Journal at all, you've known they've done like a really deep expose in the FDIC being a really toxic place to work. And I use toxic, but it's like toxic times 100.
That's right, and I think that is why this becomes even more urgent. Any kind of staffing challenges at the agency, failure to address workplace challenges become more urgent. The Wall Street Journal report is sort of alleges this boys' culture, sexual harassment. Female staff are passed over for some important roles in leading bank examinations and then criticized for not having such experience. Now, the FDIC, for its part, says it hasn't identified sexual harassment since 2020, that of course, anything like that is contrary to all of its values, but it sort of underscores and adds urgency to the fact that if it is struggling to retain talent and hire the best talent, it's going to have an issue with workplace culture.